This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Welcome back to Understanding Money. Today, we're tackling two pillars of the modern crypto world: stablecoins and DeFi, decentralized finance. Whether you're crypto curious or simply want to understand how people are earning yields, transferring money across borders, and building new banks without bankers, this guide is packed with real stories, sharp analogies, and actionable steps. 1. Stablecoins, your dollar on the blockchain. Let's start with a story. Imagine you're a digital nomad working in Bali, but your family's back in New York. You just finished a project for a US client who wants to pay you fast, but you're worried about wild swings in Bitcoin's price. Enter stablecoins, crypto designed to stay steady. What makes stablecoins stable? Most stablecoins peg their value to traditional assets, like the US dollar. Unlike Bitcoin, which might be $40,000 one week and $35,000 the next, stablecoins like USDC and USDT aim to always be worth $1. Types of stablecoins explained. Fiat-backed. Each coin is backed by dollars or euros in reserve. Every USDC is supposedly matched by an actual dollar in a bank. Crypto-collateralized. Backed by crypto, with smart contracts managing collateral. Example, DAI, backed by Ethereum. Algorithmic, use supply and demand rules or mint and burn mechanisms. These try to stay stable, but some have failed in market panics. See Terra USD collapse. Key uses, protecting against crypto volatility, sending instant low-fee payments globally, trading and earning yield in DeFi. Popular stablecoins, USDC, USDT, Tether, DAI, BUSD. 2. DeFi, finance without middlemen. DeFi stands for decentralized finance. It's all about using blockchain, smart contracts, and crypto to recreate traditional banking services, without banks. Picture this. You lend money, earn interest, swap currencies, or even buy insurance, all without an office, paperwork, or a manager. Instead, the service runs on a blockchain, and rules are set in code. DeFi building blocks, decentralized exchanges, DEXs. Trade crypto with other users, Uniswap, Curve, SushiSwap. Lending protocols, lend or borrow crypto by interacting with smart contracts, Aave, Compound. Yield farming and staking, lock up coins to earn interest or incentives, fueling network operations. Liquidity pools, provide assets so others can trade instantly, earning fees or rewards. Why does DeFi excite people? Anyone can participate, no permission needed. Services run 24/7, instantly no credit checks, collateral, your deposited crypto, secures loans. Programmable money enables creative services never possible before. 3. Real-world examples, stablecoins and DeFi in action. Remittance without headaches. Sending $500 to family overseas usually means high fees, currency conversions, and slow wires. With stablecoins, send USDC or USDT in seconds, then swap to local currency using a DEX. Earn yield on idle assets, deposit DAI or USDC on Aave Compound, and earn 2 to 10% interest, far above most bank rates. Interest is paid from borrowers interacting with the protocol. Small business loans for the unbanked. People worldwide access loans in minutes. No bank, just a crypto wallet and collateral. DeFi's promise, finance for all, if you understand the risks. 4. The technology. How do stablecoins stay stable? How does DeFi work? Stablecoins. Fiat-backed stablecoins rely on regular audits, supposedly keeping reserve assets equal to coins in circulation. Crypto-backed. For DAI, $150 worth of ETH might back $100 of DAI to provide price stability. Algorithms try to keep coins at $1 via incentives and burning minting mechanisms. DeFi. Smart contracts, blocks of code on the blockchain, enforce rules and automate transactions. Anyone with a supported wallet, MetaMask, Phantom, Trust Wallet, can access protocols. There's no customer support. If you make a mistake, the blockchain records it forever. 5. Why stablecoins and DeFi are revolutionary and why they're not magic bullets. Advantages. Global, instant transactions, transparency. Anyone can audit the blockchain, financial access for billions, no paperwork or bank account needed. Automated 24/7 services, potentially higher yields. Real stories. Freelancers in Africa get paid instantly in usable digital dollars. Crypto traders park funds in stablecoins to ride out storms. Savvy savers earn yield through DeFi, compounding crypto rewards. But here's the truth. DeFi is experimental. Smart contracts sometimes get hacked or bugged. Stablecoins can break their peg in panics. Not all projects survive. They're not insured. Responsible investing always means understanding what you're buying. 6. Risks and red flags. Rug pulls and scams. If a DeFi app promises outrageously high yields like 1000% APY, tread carefully. Sometimes creators vanish, taking users' money. Smart contract hacks. Code can fail. Billions have been lost due to exploits or bugs. Stablecoin failure. Crypto and algorithm-backed coins can depeg, becoming worthless for a period. Impersonator websites. Fake DEX or wallet sites can steal your funds. Always triple-check URLs. Over-leverage. Some protocols let you borrow against your crypto, but market moves can wipe out your collateral in a flash. Ignoring taxes. Profits or losses can be taxable events. Track everything. 7. Getting started safely. A step-by-step playbook. Read, watch, and practice. Use official resources and reputable channels to learn, not just social media hype. Create a dedicated crypto wallet. Use MetaMask or Trust Wallet for DeFi apps. Write down your recovery phrases. Never share them. Experiment on testnets with no real money. Most major DeFi apps have test versions. Play, learn, make mistakes for free. Start with small sums. Try out USDC or DAI on reputable protocols like Aave or Uniswap with $20 to $50. Use only money you can afford to lose. Diversify. Don't put all your DeFi funds in one coin, protocol, or wallet. Check security. Double-check website names, use hardware wallets for larger amounts, and enable two-factor authentication where possible. Track your activity. Keep a log of your transactions, helpful for taxes, troubleshooting, and learning. 8. Navigating DeFi use cases. Lending, borrowing, use DAI, USDC, USDT as collateral or loans. Watch for liquidation risk. Staking. Earn rewards for holding coins. Good for longer-term holdings. Providing liquidity. Support decentralized trading indexes, earning a share of trading fees. Yield farming. Move assets between protocols to chase higher returns, advanced and riskier. Insurance. Some DeFi platforms offer coverage against smart contract bugs. Check their records. 9. DeFi and stablecoins in the bigger picture. DeFi protocols are now handling billions of dollars for ordinary users and institutions alike. Stablecoins have become the backbone for digital trading and instant remittance. But the future? Expect more regulation, safer protocols, cross-chain interoperability, letting different blockchains talk to each other, and real-world adoption, payroll, savings, even mortgages powered by code. Tech is moving fast, but don't rush. The best users are lifelong learners. 10. Your expanded action plan. Research the history and design of USDC, DAI, and other stablecoins. Try test transactions on leading DeFi platforms. Join reputable online communities, RFRs, DeFi, Discord, Telegram, but stay alert for shills and scammers. Set security rules. Backups, strong passwords, hardware wallets for any meaningful amounts. Regularly review your transaction history, especially for tax reporting. Never invest more than you're willing to lose. Bookmark official websites and protocols. Avoid fake sites at all costs. Stay calm. Avoid chasing outrageous yields or FOMO pumps. Stablecoins and DeFi could reshape finance for everyone, from everyday savers and traders to businesses and governments. But with great power comes great risk. Use these innovations carefully, stay curious, and keep your guard up. Got questions about how DeFi or stablecoins work in practice? Post them below. Smash like, subscribe, and join our next explainer as we break down even more about the brave new world of digital money. Disclaimer: this video is educational only, not investment advice. Crypto and DeFi are risky, experimental, and unregulated in many places. Proceed with caution, keep learning, and never risk more than you can afford to lose. Thanks for watching, and see you next time on Understanding Money.